Welcome back to our ongoing year-ender series, Markets in 2025. Today I have with me probably one of the best of experts, Timothy Moe, Chief Asia-Pac Equity Strategist and Co-Head of Asia-Pac Macro Research at Goldman Sachs, to tell us how markets may pan out in a Trump world. Good morning, Mr. Moe. Thank you very much indeed for joining us. Well, first up, do you think that, U.S. exceptionalism is going to continue in 25? And will that draw money away from EMs as a basket?
I think it already has, to be frank.
Yes.
We have to remind ourselves that the long-standing outperformance of the United States equity market means that it's now, in round terms, 70% of the global market cap. So you just naturally, money is going to be attracted there just to be at benchmark. And then, of course, post the U.S. elections, the narrative of U.S. exceptionalism has been strengthened, really because you've had three major shifts that have taken place from an Asia perspective, which are somewhat lower growth, really in China, but maybe rippling out a little bit further. Number two, higher rates, higher U.S. long-term rates, and maybe a somewhat more attenuated easing cycle. And number three, a stronger dollar. So basically lower growth, higher rates, a stronger dollar typically are more headwinds for Asia. And I think that's impelled some money to be shifting a bit more towards the U.S., which we can see from the aggregate foreign investor flows for the region, in the past month or two.
Yeah, point taken. But can it be a state of buy the rumors, sell the news? When Trump actually gets sworn in on Jan 20th, would it be difficult for any president to, impose tariffs across the board? The inflation problem for his own countrymen will hit home. And so the markets perhaps would have already bought into it and probably used 2025 to ease off. Is that a possibility?
Latha, it certainly is a possibility. And I think there's a few elements to your question, which just to unpack it. One is that the U.S. has already rallied quite sharply since the election. And even though we established a 6,500 S&P 500 target for end of next year, we're already closely approaching to that. And there's only maybe 7% upside to that, with the U.S. market as of Friday's close trading above 22 times earnings. So clearly there's a lot more in the proverbial shop window, so to speak. So that's number one. Number two, just to be clear, our base case is for the U.S. to impose an additional 20 percentage point increase in tariffs on China and some tariffs on auto exports from Europe to the U.S. and from Mexico to the U.S., but not the across the board 10% tariff that had been threatened or raised as one possibility. If that indeed happens, that would be much more negative for global growth, but also would have impact on the U.S., both through the inflation channel and the growth channel. So we think that that is not our base case. It's a risk, but not our base case, just to be clear on that.
Okay, well, point taken. I'm just wondering if a bulk of the U.S. exceptionalism has paid out. But let me come to India. And while we have prided on being the fastest growing large economy, I'll come to the domestic slowdown in a bit. But do you think 2025 can mean more headwinds as businesses all over the world grapple with the uncertainty of tariffs and probably even bans in investments?
The quick answer to that, Latha, is yes. But let me just explain why, and then maybe make a comment on India as well. So we've shown in a number of our research, whether it's macroeconomic or the strategy research that my team has been doing, that there's a transmission channel from what we call economic policy uncertainty, and trade policy uncertainty is a subset of that, and the impact that can have both on economic growth and also on earnings. And the simple way to understand that is that when you're uncertain about what the operating environment is going to be, which is what policy uncertainty attempts to capture, then you typically would have entrepreneurs not invest as much. So your capital expenditure may not be as great. And therefore, that might have an impact on both economic growth and on earnings. And indeed, we've shown for Asia that there's a clear linkage between increases in global economic policy uncertainty and Asian earnings. And also, for example, in Europe, we took our forecast down from 1.1% for euro area GDP next year to 0.8%. And a good part of that was through that trade policy uncertainty channel. So I think that there is a direct connection there. Now, I'd say the better news for India specifically, which of course is what your audience is focused on, is that India is more of a domestically oriented economy. It's got much more domestic engines, as you well know. And so, it may be somewhat affected by that, but certainly not as much as the more, globally trade oriented economies, whether it's China or Japan, Korea, or Taiwan. Those are much more in the crosshairs of that concern.
Okay. Oh, yes, I get that point entirely. But, the great Indian story of growth of the last 3 years kind of lost its sheen a bit when we got the July-September GDP growth, which came in at just 5.4. Market expectations were at 6.7. So do you think, I have your report, Sunil Kaul's report on the earnings expectations. Do you think you all will have a downside risk to those estimates?
So let me just be clear. So we love the India story and have done so for quite some time. That being said, we downgraded our view on India about 6 weeks ago. And really the reasons were twofold. One, that valuations have gotten very, very high. On September 26th, which was the peak of the market, it were over 25 times forward earnings. And number two, we expected there would be some sort of what we call a mid-cycle correction, both at the economic level and at the earnings level. So directly to your question on earnings, yes, we have taken our numbers down, and as has consensus. At the end of September, we were looking at 14% and 15% 2024, 2025 growth. We're now looking at 12 and 13. So we've taken about 2 percentage points out of each year, and consensus is done roughly similarly. So we're still a bit below consensus, but both we and consensus have taken our numbers down. And that's clearly because it was a soft reporting season for the fiscal second quarter, calendar third quarter. And looking forward, we think that's going to persist for the next maybe 1 to 2 quarters. So, we were basically calling for that sort of mid-cycle slowdown. And in the context of elevated valuations, we thought the market was due for sort of a period of range trading and consolidation. That is kind of what's been happening. And we think that's going to persist for a little while longer. But looking forward, we think that that should hopefully afford an opportunity for investors to re-engage, for another leg up in the market, but one that might be, not until sort of the middle of next year.
Okay. I know you'll have other experts looking at currencies in particular, but overall, since you have to advise equity investors, how much of a worry would you have on the rupee, not just because of the dollar strength, but also because, exports, dollar inflows that are likely to be stymied, primarily because of U.S. exceptionalism. Do you expect that the rupee could be impacted, or could it be the converse, that India gets included in more bond indexes and therefore there are other kinds of flows? And the big one, do you expect a rating upgrade, which can change the terrain a bit on the currency front?
Your question is well asked, and the ingredients of your question highlight that there are both positive and negatives, as there always are, but there are important positive and negative ones. Look, our bottom line is that we think that there may be some modest weakness for INR, for the rupee, but in a strong dollar environment, which our base case is that we think that the dollar will remain higher or stronger for longer, and that most Asian currencies will depreciate modestly from current levels against the dollar. They already depreciated some, but maybe a little bit further. Within that spectrum of currencies in Asia, we think the Indian rupee is likely to be one of the stronger ones, or the more resilient ones, for a host of reasons, having to do with the fact that the economy is growing well, that the external dynamics that contribute to currency moves have improved in India's case, certainly in the decade since we had the so-called taper tantrum in 2011, when both the Indian rupee and the Indonesian rupiah were the weakest in Asia. There's been very significant changes since then. There's been some fiscal consolidation, which of course is fundamentally supportive of the currency. Oil prices are low, which is one of the traditional areas that's been a vulnerability for India on the external front. So we actually feel, pretty constructive on a relative basis, but recognize that in a broadly stronger dollar environment, that there may be a bit of further weakness, but as I said, less than for other currencies in the region.
Okay. So you are factoring in a lower dollar. Yeah, I think you are above 85 or something. I read the report.
Correct. Yeah.
Yeah. Timothy, I know the nitty-gritties, the micros of India are Sunil Kaul's area. But broadly, what are the sectors that you would look at? I think you are very positive on the affluent Indian story.
Yeah, absolutely. So in terms of sectors, it's a bit of a potpourri because we're really playing off a number of different themes that we like, as well as trying to balance, liking the underlying growth story, but recognizing we need at least, for the next maybe 1 or 2 quarters to be a little bit more tactically conservative. So we've got, as I said, kind of a mix, which includes the IT sector. We kind of upgraded that for a variety of sector-specific reasons, including the fact the valuations look better. We like the auto story domestically. We like the telcos. We like the internet, which is sort of the subset of that is e-commerce, travel, and so on. We like insurance and also like the real estate story. And we're kind of so-called paying for that by being underweight financials, which would be the banks and the NBFCs, cement and chemicals, the oil marketing companies, and durables. That's kind of how we're balanced within the market.
Welcome back to our ongoing year-ender series, Markets in 2025. My guest today is Bhanu Baweja, Chief Strategist at UBS Investment Bank. And I'm going to ask him more about the world, about which he has a better view than most of us here in India. Bhanu, thank you very much for dropping into our studios.
It's a pleasure.
Now, a month from now, or a month plus 10 days from now, we are stepping into a Trump world. Can you just give us a peep into how it will look? Until now, it's all guesswork. We're extrapolating Trump 1.0 into 2.0. You tell us, what do you think will be the main contours of the new 2025 order?
So the markets are already in a Trump world, right? So the markets have been anticipating Trump even when Trump wasn't elected and even when the polls were saying that it's unlikely that he comes on. So if you look at how stocks have performed, if you look at how term premium and the fixed income has gone, they were fully anticipating Trump. And after the election, you have seen many of the Trump trades also play out in earnest, right? The dollar has been strong. Financials have done quite well. The term premium in the yield curve has remained quite high. So most of the Trump trades are playing out. My sense is that once you actually get Trump's inauguration, there could actually be a phase where you actually have a reality check, because you are pricing in most of the good things that Trump is going to do for the markets. You are pricing in deregulation, or at least, even if it's not fully priced in, you're talking to a considerable extent that's a part of the market narrative in financials, in energy, in real estate in the US. You're thinking about deregulation. You're looking at lower taxes. But again, if you look at 2026 earnings, pre-tax and post-tax, you can back out from there a tax rate, and that tax rate is 19%, which is below the 21% you are. So you are expecting lower taxes. What you're not expecting, and I really struggle to see this in any asset class, is tariffs. Now, all media channels are sort of crying themselves hoarse about how tariffs are coming. Nothing in the market says tariffs are coming. The markets are smart, you have to give them that. But basically what the markets are implicitly assuming is that this is a transactional position, that Trump comes in and then he negotiates, and then, you pull back. And so tariffs are not a long-term issue, and it's not going to hit the economy.
He's using it only for
it's a bargaining process, right? He's getting his way. That's an assumption, right? And that's an assumption which I think has been cemented by some picks that he has made in his cabinet, like Scott Bessent, really has a conservative view on tariffs. He's always been saying, in fact, on your channel in the US, he's been saying that we will never take a maximalist approach. But it's not clear at all that he will have the call. The Ministry of Commerce, USTR, US Trade Representative Office, will have the call, and they are talking about tariffs. So that's not priced in. That's one of the reasons we think the markets will face a reality check. By the way, most of our clients disagree with us. They think the US economy is blue hot right now. It is. And they think that moving forward, earnings will continue to do well, valuations will continue to go higher. I think it's a very different setup from Trump 1, where it's hard to see valuations rising. I mean, consider where credit spreads are in the US. They're the tightest they have been in 25 years in this century. Whereas in Trump 1, you had a lot of risk premium on the table that you could shrink and then see valuations going up. So different setup.
Okay, so how do you visualize yields going? How do you visualize the Fed reacting? and more importantly, the dollar?
So very importantly, even before we talk about sort of what Trump's influence on all of these is, we have to ask ourselves, what happened to the US economy in the last 2 years, right? We've heard this metaphor.
It's strengthened.
It's strengthened, and the metaphor that's used very often is that it's been exceptional. So what was exceptional? Was productivity exceptional, or was just consumer exceptional? In my humble opinion, it was just the consumer that was exceptional because of exceptional stimulus. So this is banal, old school factors like stimulus, like immigration.
Fiscal steroids.
Fiscal steroids, as opposed to new world productivity. If that diagnosis is correct, then in the next 2 years, you should see a material step down in consumption and therefore a material step down in US growth. So we are not looking for a recession, but we are saying US nominal GDP goes from a very high 5.5% to a slightly below consensus 3.9%, right? If that happens, inflation will first come down. Tariffs, immigration, lack of immigration notwithstanding, inflation first continues to come down. And what we think, therefore, is that the Fed is going to go close to its neutral, so go close to 3%. The markets are not anticipating that. The market says that it's going to go to just under 4%. So we are more positive on the Fed cutting because of lower inflation than is the street, but because we are more negative on US growth than is the street. The street assumes what happened in the last 2 years will happen in the next 2 years. So it's a case of simple extrapolation. We don't think we should be doing that.
Okay, now if the US growth is not going to be exceptional, one of the big reasons that helped India is also our growth was good because of our fiscal steroids, but also because the world was being a positive place. Do you think we're going to face a lot more global headwinds as we try to estimate next year's growth? How heavy will be the global headwinds?
The global economy is going to be less friendly than it was in 2023 and 2024 because China is not improving, right? China, despite its stimulus, will see drag in the property market. China will see tariffs compromising global trade further. So that is not a great situation. Europe is going to improve, but you'll have to look at Europe under a sort of magnifying glass to see the improvement because it's very minuscule, right? China and the US are coming lower. So that creates for lower global growth than we have been seeing in the last 2 years. We've been seeing slightly below trend global growth. We go further below trend. So we go from about 3.2% global growth to 2.9% global growth. One thing we've got to be a little bit careful about is, again, China, right? Because if the US administration was to shut down all the routes from China to the US, if they were to shut down Mexico, if they were to shut down Vietnam, the routes that China has taken to maintain market share in the US, then there's a possibility that China really dumps capacity on the rest of the world, on Europe, Asia, Africa, India, right? And we don't think of China and India as trading partners, but you look at the data, they really are. So India's private capex could be negatively impacted by the amount of industrial capacity or manufacturing capacity that's coming the rest of the world's way. So there, while the whole world is worried about inflation coming from tariffs and coming from lack of immigration, that is true. I mean, that could be the trade after the trade. But what we also have to be really cognizant about is that there are serious disinflationary winds within this region coming from China. China is already in deflation. So if I'm a US corporate, if I'm a European corporate especially, or an Indian corporate, I really have to worry about what my margins are going to look like in a world where China's always adding capacity, right? So China's response to every demand problem is to add more supply, right? So that is a problem for the rest of the world, and that's disinflation.
Oh, yes, actually, even in 2018, when Trump had announced much lower tariffs than what we are expecting now or what he's saying now, we did see business confidence and business investments go down globally. We are only hoping that India is less impacted than other countries.
That's absolutely true. India will be less impacted, and compared to the downside that you could see in Europe, or compared to the downside in some of the more open economies in this region, you could actually see India hold up better. Okay. And Indian markets are also sort of benefiting from not just global flows, which they haven't seen much of, but also local retail flows.
Which is what I'm coming to. How do you assess the Indian market? Forever, people have been saying that it is expensive, but it's not really given up much. It's just about 6% of the September end highs. Two different questions. One, how do you see growth, both GDP and earnings? And separately, is this flows inexorable, and can the market continue despite being expensive?
It is, I love the way you frame it, because it is absolutely right. You almost have to, so the delta in a cycle is going to be driven by the earnings cycle. It's going to be driven by margins. It's going to be whether operating leverage is going up or operating leverage is going down. And right now, we have been in an earnings down cycle. And I think we will probably be troughing sometime soon. You can't really see the signs of a big renaissance, but it'll come, right? It'll come at some point, perhaps in the second quarter of the next calendar year. You should be able to see urban consumption beginning to does not decline anymore. Rural consumption improves, and perhaps a little bit of private capex pickup, which is not a big statement because it's been so weak. You can actually see that pickup, and also fiscal's actually been quite tight.
Yes.
Right, and so in the next calendar year, next fiscal year, you could see that. So it will not be surprising to see growth bottoming out after a period of consolidation. We first have to go through that consolidation. So can't sort of be super optimistic about, one day we'll.
No, we're going through the consolidation.
Yeah.
Q2 was the fact, the quarter that hit us. But yeah, so you see 2025 as a recovery year.
I see 2025 as a recovery year, but we first need to go through the consolidation, right? So again, there's a trade, and then there's a trade after the trade. We have not been through the consolidation fully, but that's the cycle, right? But what has happened in India, especially post-COVID, is that the ease of trading for many folks in the retail space has been so enhanced that people have been through SIPs and also through directly into the market, putting more and more money into the market. Now, that is a dangerous game. There's no doubt about that. But, think about what these people's P&L is, right? They have not seen a downturn. They have not seen a downturn, right? We've sort of grayed our hair in these markets. We know downturns come, right? You haven't, by the way. But we know downturns come. But they have not seen a downturn. So their stop loss, they're not going to get. So they are buying the dip all the time. And for them, it's a rational response, right? If I've gone from 100 to 180, if the markets go to 150, people will buy the dip. So that's why I think we have to be careful that despite the consolidation in earnings or revenues, the dips in India for now could be a little bit shallow. Now, at some point, you have to pay the piper, right? At some point, when the flows are coming down, you could actually see the opposite situation where the macro is fine, but the flows are going to turn much more negative. Everything that I'm seeing suggests that we are still quite a long way from that.
Okay,
right?
let me stop you there because I'm being warned we're out of time. So just tell me, at the moment, what you are you manage cross assets. You're the global asset manager practically. What are your top 3 assets now, and what do you think will maybe the top 3 assets in the second half of 2025?
Right. So at this minute, we are actually playing defense, right? So we're buying very conservative sectors within the equity markets. We are long the front end. So we're long fixed income, and we're long the front end of the US. We don't think the back end comes off very, very aggressively. And we're also long dollars, particularly against emerging market currencies. So we think the INR weakens, we think CNH weakens. So these would be some of the defensive sectors, front end of the US curve.
And dollar.
And dollar against emerging markets. I think the yen is actually going to do quite well. But against emerging markets, the dollar will strengthen. In 6 to 9 months' time, if I could anticipate trades based on the kind of things that I've said to you, I see US markets actually coming lower. And then there's a possibility that markets like India could see an upcycle. And on that basis, at T+6 or T+9, you could actually see the Indian markets doing reasonably well. So that would be my trade after the trade. But we really have to go through the trade first. And there's a whole sort of plethora of possibilities.
Thank you very much, Bhanu Baweja. Absolute pleasure having you with us. With that, we wrap up this part of our discussion on the year-end series. But after a break, we will have more experts joining us on 2025 and how it will pan out.